Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about La-Z-Boy Incorporated quarterly report. La-Z-Boy Incorporated offers a wide range of businesses and services that cater to the needs of consumers seeking high-quality upholstery furniture products. The company operates through two primary segments, wholesale and retail. The wholesale segment provides various types of upholstered furniture, including recliners, motion furniture, sofas, loveseats, chairs, sectionals, modulars, ottomans, and sleeper sofas. This segment also imports case goods, wood, furniture such as bedroom sets, dining room sets, entertainment centers, and occasional pieces. The company sells its products directly to various retailers, including La-Z-Boy Furniture Gallery stores, operators of La-Z-Boy Comfort Studio and branded space locations, England Custom Comfort Center locations, dealers, and other independent retailers. In addition to the wholesale segment, the retail segment offers a wide range of upholstered furniture, case goods, and home furnishing accessories directly to end consumers through its retail stores network. The company also licenses its La-Z-Boy brand name on various products, allowing it to expand its reach and offerings. Furthermore, La-Z-Boy Incorporated operates Joybird, an e-commerce retailer that manufactures and sells upholstered furniture primarily online through its website and small-format stores in urban markets. Overall, La-Z-Boy Incorporated's diverse range of businesses and services enables the company to cater to various customer needs and preferences, making it a leading player in the upholstery furniture industry. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to drop. The decline of La-Z-Boy Inc.'s stock price over the past year can be attributed to several factors. One possible reason is the company's struggle to adapt to changing consumer preferences and market trends. As consumers increasingly turn to online shopping and e-commerce, traditional furniture retailers like La-Z-Boy may find it challenging to compete. Another factor that could contribute to the decline in stock price is the company's financial performance. If La-Z-Boy Inc. experiences a decline in sales or revenue, it can negatively impact investor confidence and lead to a decrease in stock value. Additionally, if the company fails to meet its earnings expectations or faces increased competition from other furniture retailers, it could further exacerbate the decline. Furthermore, external market conditions such as economic downturns, changes in interest rates, or shifts in consumer spending habits can also affect La-Z-Boy Inc.'s stock price. If these factors are unfavorable, they can lead to a decrease in investor confidence and a subsequent drop in stock value. In conclusion, the decline of La-Z-Boy Inc.'s stock price over the past year is likely due to a combination of internal and external factors. The company's ability to adapt to changing market trends, its financial performance, and external market conditions all play a role in determining its stock value. La-Z-Boy Incorporated maintains a market capitalization of $1 billion, broadly in line with the industry peer group. La-Z-Boy Incorporated trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 1.43 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 46% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 2.73%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted a company's top-line performance. On the positive side, revenue growth has been driven by several key initiatives. Firstly, sales have increased significantly, with notable gains in both Page 2 and other sections. The acquisition of retail businesses has also contributed to revenue growth, as has the expansion of manufacturing locations and distribution centers. Furthermore, the company's strategic priorities to grow its company-owned retail business and leverage a vertically integrated retail model have paid off, resulting in increased sales through La-Z-Boy Stores retail network. Additionally, incremental sales from retail store acquisitions and increased sales from retail store expansion have also contributed to revenue growth. On the other hand, revenue decline has been driven by several factors. Net income decline, decrease in receivables, and increase in payables have all had a negative impact on revenue. The disposal of case goods wholesale business has also resulted in a decline in revenue. Lower delivered same-store sales in retail segment and lower delivered volume in case goods and Joybird businesses have further contributed to the decline. Overall, the company's revenue growth or decline can be attributed to these key drivers, which highlight the importance of strategic initiatives, acquisitions, and operational efficiency in driving top-line performance. The net income of the company experienced a significant decline over the past year. Initially, it decreased by 24.7% from $28,945 to $21,800 between January 25, 2025 and January 24, 2026. However, when looking at the 9-month period, the decrease was less pronounced at 19.3%. On a yearly basis, net income actually increased slightly by $93 from $18,204 to $18,297. The profit margins of the company also underwent changes during this period. The gross profit margin decreased from 44.2% to 43%, while the operating profit margin dropped from 6.7% to 4.8%. These declines in profit margins can be attributed to several factors. Firstly, there was an increase in depreciation and amortization expenses, which rose by $604. Additionally, equity-based compensation expense increased by $1,683. The decrease in net income and the decline in profit margins can also be linked to higher SG and a selling, general, and administrative expenses and interest expense. These factors collectively contributed to the changes observed in the company's financial performance over the past year. The company's financial performance is a notable aspect of its overall health. One key indicator of this is the generation of positive operating cash flow. This means that the company is able to generate more cash from its core operations than it spends on various activities such as paying off debts and investing in new projects. According to the provided information, the company's operating cash flow for 2026 was a significant $175,690, which is a clear indication of positive cash generation. This trend continued even after 9 months into the year, with net cash provided by operating activities also amounting to $175,690. Management is emphasizing the importance of strategic priorities in driving the company's growth. The primary focus is on expanding its retail business through acquisitions and leveraging a vertically integrated model to achieve synergies. This growth strategy involves entering new markets, integrating acquired stores and businesses, and recognizing goodwill for future benefits. The Century Vision Plan aims to deliver long-term value to shareholders by increasing sales and market share while strengthening operating margins by 2027. Key strategies include expanding the La-Z-Boy brand reach, leveraging consumer insights, and enhancing its appeal to a broader audience. The company is also investing in growing its store network, wholesale distribution channels, and enterprise capabilities to support this growth. Management's outlook suggests that acquisitions will play a significant role in driving future growth, with expected synergies from integration contributing to the company's success. By executing these strategies, management believes the company can achieve its goals and deliver value to shareholders over the long term. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts over the past 2 years. According to the financial reports, in 2025, the company paid $25,871 in dividends, while in 2026 it paid $28,082. Additionally, on page 34, it is noted that the company paid a total of $28.1 million in dividends. The company has also been actively buying back its own shares to reduce the number of outstanding shares and increase earnings per share. In 2025, the company repurchased -807 shares, while in 2026 it bought back -13,859 shares. Furthermore, on page 34, it is mentioned that the company spent $27.1 million to repurchase approximately 0.7 million shares. Overall, the company's commitment to returning value to its shareholders through both dividend payments and share buybacks demonstrates a strong focus on shareholder value creation. The company is facing concerns about inventory buildup and potential disruptions to its supply chain. The data suggests that there has been a significant increase in finished goods inventory, with an increase of $23,510 from April 2025 to January 2026. This accumulation of inventory may indicate inefficiencies in the production process or difficulties in meeting demand. Furthermore, the company is planning to close its upholstery manufacturing business in the UK by the end of fiscal 2026 and cease production at this facility. These actions are likely aimed at optimizing supply chain operations, but they also pose a risk of disruption to the company's ability to meet customer demands. The operating losses and charges related to these supply chain optimization efforts further highlight the challenges facing the company. The combination of inventory buildup and potential supply chain disruptions raises concerns about the company's ability to manage its operations effectively. Addressing these issues will be crucial for maintaining a stable and efficient supply chain, as well as ensuring that customer demands are met in a timely manner. That concludes the financial summary for La-Z-Boy Incorporated. Feel free to comment below, and I will be happy to answer them when possible.